This is the market review for gold. So today we had two setups. We had the London Open setup, and then we had the New York Open. So during London Open, we had this high, and also these highs, as you can see right there. So those two highs. So they got taken out right there. So yeah, those highs. So we had these highs right there. So we had these relative equal highs, and then we had also this high being taken out. So we had that. So when that happened, we anticipated for shorts going down into these lows and eventually trading inside these fair value gap, and eventually maybe taking out these lows, but that didn't happen. So we traded to the downside, got nearly taking out this low, but we didn't. So price reversed, came all the way up during London, and during New York we had this sell-off, but notice it did not take this low out. So that makes these lows relative, and that is signature for price. You should know that if you see a low not being taken out and price moves to the upside, you just know it's going up to go down. So because we preserved this low, yes we did, we had a small fair value gap right here, we had that. So if you extend that through, that held price, but sell side was residing below these lows, and we had this inefficiency, and eventually we had these lows. So while we were up here, we traded inside these this fair value gap, and then we had a bearish order block. So we traded inside that during the New York Open at 8:30. So we had a run to the upside, taking out all these highs, trading inside these inefficiency, and we had a bearish order block right there. So we had that, and that was at 8:30, exactly 8:30. So we traded inside that, and then we came down, taking out these relative equal lows, and eventually now we are working on this. We have not yet taken out these lows, but this is the next drawn liquidity. So we are only going up to go down, taking out these relative equal lows. So if we head over to the 1 minute chart, this is the 15-minute chart. So let's head over to the 1 minute chart. So we have so we had this during London Open. So it went up, took out the buy side, then we had it created us a swing low, which got taken out right there. And then we had a fair value gap. So this is the 2022 entry model. So you could be going short right in this fair value gap, placing your stop somewhere like there. So we had that, because now this becomes a breaker. So we had high, low, higher, high. So the down close candle becomes a breaker. So if you place your stop just above the breaker, it is safe. So we had that, what we could be aiming for, we are to aim for these lows right here. So take that, and then right there. So that was a 5.65 hour trade. So we had that. It was quite clear. We had that. We were to sell from 2035, and our take profits would have been in at 2031. That's not bad. So we had that also during the New York Open. We had this run to the upside, as you can see. This was the run low that preserved this low that this line denotes. So it preserved that low. We had that run to the upside, and then we had a fair value gap right there. So we could be going short right there, placing our stop just above the midpoint of this week, because our price could revisit the midpoint of that week and trade into that. So to be safe, your stop should be just above the midpoint of this week. So if you were to go short, we're going short right in this fair value gap right there, and your stop should be just above that the midpoint, and we aim for this low being our first target. So we had that low, and also we had the relative equal lows. I believe it is where price came. So we had that. This is about 4.23 hour trade. So that's a total of almost 10 hour for gold. So that was quite easy. After these lows taken out right here, we had you could go to break even right there after these lows taken out right there, and then anticipate for a run into this low, taking partials, and eventually the relative equal lows. So I guess that's it for gold, and until I talk to you next time, be safe.